Welcome back, Alpha Hunters. In this video, I'll be covering the option Greeks Vega and Rho. I'll define what these terms mean, why they are important, and things to be mindful of. Then, show you some charting examples of how they work and how to find this information in your broker. See you on the green side. Hope you are ready to travel into the black hole of all the Greeks. If you trade options long enough, you will get burned by volatility eventually. But there are great opportunities when it comes to making returns consistently exploiting volatility. Keeping your eye on volatility levels will let you know what option strategies to use. If you have ever noticed options having elevated prices compared to what you think they normally should be, most likely implied volatility is the culprit. Vega tells us how much we can expect the price of the option to change for a 1% point increase in the stock's implied volatility. Since options are future bets on what the market participants think the price of the stock will be in the future, the stock's implied volatility tells us if the stock is expected to make such a move. So, as implied volatility increases, the possibility of reaching more strike prices also increases. Therefore, the increase in the options price. Vega just tells us the impact a 1 percentage point increase in implied volatility will have on the option price. Vega is represented as a positive number for both calls and puts, since it is a measure of an increase in volatility. If you charted Vega for all strikes in a given expiration, the line would look like a bell curve with the peak being at the money. So volatility can be a tricky component to manage with options, but checking the stock's volatility levels before entering a position will give you a perspective of what the market is expecting and how to play the current environment. As you continue on in your career with options, I'm sure you will sell options to open positions. If you have these positions on and the company of the stock announces some new event taking place before the options expire, close the position ASAP. Trust me. You might have to close it out at a loss, but it will be much smaller than what the alternative could be. There is now a new catalyst that you didn't account for when opening the position. But there are a great many opportunities to sell options before such events. But you need to limit losses with protection, just in case things get a little crazy. You will hear about scenarios like volatility collapse or IV crush, and these are just referring to an expectation of implied volatility falling. And just remember, this is volatility. Sometimes it gets a little volatile. So we go from Vega and volatility to Rho and really boring. I actually wasn't even going to cover Rho, but with the Fed talking more about raising rates sooner than they previously thought, figured why not. With Rho, it represents the value an option will change for a 1 percentage point increase in the risk-free rate. For options that are at the money and farther out in time, they will have more sensitivity to the changes in the risk-free rate. Something to keep in mind is rates usually change a quarter or half point at a time, and Rho is for a whole point. Rho just hasn't been a factor over the past few decades, as rates haven't changed that much. It's like that person at the party that doesn't interact with anybody, just standing there in the corner by itself. Okay, here we are on the broker, and we are looking at SPY calls and Vega on SPY calls. And what you notice, it's very much just a typical bell curve. Nothing out of the ordinary, but with the peak being at the money. Okay? So that's what calls looks like. This is what puts looks like. Very much a bell curve. Gets a little wonky as you go in the money on those puts right there. But here's what out of the money looks like. It's very much linear, or not linear, but a normal looking bell curve. What you would expect to see on that front. So nothing too too weird there about how Vega looks over time. So, and just so you know, if you haven't heard me before, each one of these lines represents an expiration date. Okay, and you got the strikes down below, and then the price of Vega, the impact of Vega on the left side. So, so as you can see, the closer to the middle you get with these strikes, the higher you get on how much Vega is impacting the option price. Okay? So that's how you kind of read that. And then Rho's a little different. It's Rho kind of looks like a bell curve on calls. And it's kind of weird because you switch over to puts, and it looks like this. And then, you know what's funny about this is on the left side over here, it's actually negative values. So, yeah, I mean, nobody really cares about Rho. sorry to say it, Rho. Just nobody cares about you. It just doesn't change that much. So, yeah, I mean, it's not that big of a deal. And unless they start getting to where they're changing rates like pretty often, but you know, then we might start looking at some possibilities to exploit that. But right now, in the past 20 years, it really hasn't been the case. Okay, and what it looks like out of the money is really wonky. So that's what Rho looks like. It's not really a big deal. We're going to talk a little bit more on Vega and go see what it looks like in the options chain. Okay, so let's go over here. We'll go find an options chain and go to the 20th December. Let me switch to here. Okay, so we have here delta, gamma, theta. Those three we're not going to worry about. Then we got Vega. Okay, and we got Vega here for the calls. And we got Vega over here. And this is the put side. Put side, call side, strikes. As you go up on the screen, they actually go down in strike price. Okay, so zero is kind of at the top, way up there somewhere. So what we can see with Vega here is an expectation of what the price will do if volatility, if implied volatility went up like from 26%. Let's no, you know what? We're not going to use that number. Let's say if implied volatility was at 33% and it went to 34%, you could expect this option price right here to go up by 27 cents. That's what this is saying. Okay, and you know, vice versa. If the implied volatility decreased by 1 percentage point, you can also expect this option price to decrease by about 27 cents. Okay, that's how you understand what volatility is telling you, and it makes perfect sense. So think about it. Okay, so if volatility increases, okay, the stock and the volatility in the stock increases, it can now go to a wider range of possible price levels. Like if it originally had a implied volatility, let's say, 33%, and over a given period of time, it was expected that volatility it was very logical for it to go from 470 to maybe 475 to 465. Okay, but then you increase the volatility, and now it has a better possibility to go to 476 and 440 or 464. So that would increase the price of the option. So you just think about it in that terms. Like if you increase the volatility, now it has a wider range the stock can go to, which will increase the price of the options. Okay, so that's how you think about that for Vega and how it will impact your option prices. Okay, now just also remember, as you go farther out in time, the Vega numbers will become higher in value. So if we look at the near-term options, like Vega's pretty small, right? I mean, 8 cents, that's nothing. But if we go out much farther out in time, we're getting to like $2, right, in volatility. So yeah, if you get an increase in implied volatility, it will have more of a price impact on these farther out in time options. Okay, so that's how you understand you read volatility of Vega. Now Rho, I can change these layouts around to see different like Delta, Gamma, Theta, Vega, and have different layouts. The default layouts, Thinkorswim doesn't even have Rho up here. There's no Rho on any one of these default layouts. So I mean that just kind of tells you how much Rho is really looked at. It's really not looked at. It's just one, but it is one of those things that it is kind of good to be aware of. Like, okay, Rho is the impact of interest rates. That way, if interest rate changes start to really be a common occurrence, you can definitely use that to your advantage. Being aware of like how that will change things. But they do have it in here in Thinkorswim. It is in here, so you can definitely add it in for any purposes that you might need. Okay, but for most cases in point, you won't need it. You won't need it. Okay, but hopefully this helps you understand Vega a little bit more, and give you a brief look at Rho. Okay. Alrighty. Take care, Alpha Hunters.